what's your current assessment of the U.S. economy and the banking system?
So on the economy side, we are already in a very kind of puzzling moment for the economy because you had a Fed that was hitting the brakes very hard, tightening very aggressively, and people were kind of befuddled by why there had been very little perceptible effect on the labor market, for instance, why job growth is still roaring at 300,000 to 500,000 jobs a month. The unemployment rate is still near 50-year lows. At the same time, there were signs of fraying. Growth is slowing and consumer spending is slowing a little bit, but there was certainly no sign of imminent recession as many had feared at the end of last year. There had been a kind of renewed hope for a soft landing as we entered this year. But what a difference a week makes, right? Because we went from, it was really an incredible whipsaw moment that, you mentioned I've been doing this for 20 years. I don't know if I've seen this big of a whipsaw. And I guess the 2-year yield reaction tells you I have not, because I was not watching markets in the early 80s. So because that move from basically pricing in a 50 basis point hike in the March meeting and a terminal rate of like 6+% to now basically pricing in maybe a quarter point, maybe a pause, and then the Fed is close to done, is just an extreme repricing for all markets. And it tells you kind of the gravity of the situation, which brings to the second part of your question, which is what's the state of the banking system? I think what the SVB and Signature Bank crises thus far reveal is that I think it's, the financial, not just the banking system, but I think the financial system writ large is potentially a lot more fragile and susceptible to these rate hikes than people had thought. The whole notion that the Fed could just hike aggressively without something quote unquote breaking, it was fanciful, the whole time. And there are these lags in the policy's effects and in the way that people feel interest rate hikes. And now we're starting to see that. And I imagine that SVB will not be the last episode, although I can't predict how severe things are going to get.
Just talk for a minute about the quandary there that the Fed is in here, right? Because it as I understand it, and you talk to these guys every day, killing inflation is their number one priority, but more and more people are sort of stacking up against the Fed saying, hey, buddy, you got to stop it. You got to stop it. So where is the Fed's mind here? We've had Powell being really hawkish, but we've got kind of the political world, like I said, kind of increasingly pushing back on him. And the market, until very recently, hasn't been believing him, right? Has been saying, yeah, I know you say you want to hike further and then hold for the rest of the year, but we're pricing in a pivot long before then. So what is the Fed thinking right now in regards to that dilemma?
First of all, the irony is Powell had just finally won the market over in terms of that repricing that he wanted to see, right? The market was finally pricing out the rate cuts. It was finally pricing in a higher peak rate. It was doing all the tightening that Powell wanted. It's funny because I look back at when I came on your show back in October, and I said that the people hoping for a Fed pivot, had another one coming, basically, because you're hoping for something terrible to happen because it's going to be a very high bar. And I think I made the point specifically that it was likely going to be a financial event that did it before an economic event, because the economic slowdown is what the Fed wants to see. What the Fed doesn't want to see is dysfunctional markets where the transmission of monetary policy itself is kind of challenged and compromised, right? And where it has to come up with, and we even talked about this in October, with specialized lending facilities for specific targeted markets and so on. And the chance that they might resort to those in case there was any case of market, any problems of market stress. But the Fed's challenge has just increased dramatically. I mean, the Fed already had a challenge, as you say, to pace, to figure out exactly what the right balance was between not doing enough and doing too much. It had been leaning toward the side of doing a little bit too much, because it's sort of, these particular officials have a mindset of not repeating the mistakes of the Volcker era and not doing start-stop monetary policy and making sure that inflation expectations are indeed well anchored. And they have this sense that the longer that we get these high inflation numbers, the better chance there is for people to start expecting inflation to remain that high and for, wage demands to catch up and create a wage price spiral of the sort that we had in the 70s. So that's been pretty much their top priority, as you mentioned. But financial stability is another big one, and it's something they don't take lightly at all. So this presents a real challenge as to what to do. I think there's going to be a division within the central bank now between those who think that like it's just incongruous and kind of ridiculous to be to be tightening monetary policy on the one hand while you're easing macroprudential policy on the other. But there is going to be a contingent, especially on the hawkish side, a few people like Chris Waller, who's already made this point kind of preemptively that, hey, if we run into any financial stability trouble, we have the tools to deal with those, and we can keep hiking interest rates separately. It remains to be seen whether that's possible. The Bank of England happened to pull it off, back in October when we last spoke. They were able to halt QT for a period and then return to that market. But, if this becomes something more severe, we'll see what happens.
Okay. So, you talk to people who work at the Fed, right? What is their level of stress right now? Is there, I guess, do they feel while it's gotten more challenging, they still have the tools and, the know-how to get this under control? Whether we believe that or not, do they believe it? Or are they beginning to show signs of real anxiety here?
Well, unfortunately, or maybe fortunately for the Fed, this happened during a blackout period where they're not supposed to talk to media at all, at least not about monetary policy, right? But of course, they had an extraordinary action on Sunday night. So they did have to do a formal release of that information, and they did hold a briefing with reporters. And the message from senior officials at the Fed was very much that this new facility is broad and sufficiently calibrated to solve the problem. The question that I had was, what's your plan B? What happens if bank stocks continue to sell off, and if people continue to lack confidence in their deposits? And their answer was basically that we think that this plan will work, because of course, if you reveal your plan B, I imagine that the market would probably test it. So I don't fault them for answering my question that way. But they didn't let on any particular nervousness, but again, it is a blackout period. So it's not like I can call your average economist and just get a sense of what's happening. But I mean, you can sense from how quickly they took action as to how seriously they took it. I mean, just to give you a sense of the gravity, it was basically a bank that most people in the country had maybe not even heard of before was granted a systemic, exemption. It was basically treated like a systemically important institution for a day, and now for at least a year, as they have this open facility. Which again suggests that the banking system is more fragile and the connections are deeper. If people, if something that happens at SVB can have systemic implications, then the threshold is a lot lower than we thought.
Before the banking instability happened, I sort of look at it as like the Fed is trying to bake a cake, and it's the tools it has to bake the cake are a blowtorch and a freeze ray. Right. And it's really just sort of like trying to shoot them, as it can at the cake, and try to engineer this, comfortable baking temperature, but it has these two really extreme tools to do it. And so the odds of it getting the cake perfectly baked aren't great to begin with, right? But then with the instability of the banking system, it's almost like you're putting a timer on the Fed saying, hey, you got to bake this cake pretty quickly because guys are coming to shut down the kitchen. I don't know if this is a good analogy or not, but it adds this pressure to what the Fed's trying to do, right? It's like, all right, look, I'm trying to engineer this as soft a landing in inflation as I can, but the system itself seems like it's beginning to become super unstable. And so it forces the Fed, I think, to make a decision, which is, we got to kind of like, really accelerate what we're trying to do here and get this damn cake baked fast, or we got to switch our focus and stabilize the system first. So to me, from what I can tell right now, let's
just freeze the cake and we'll bake it later.
Yeah, well, I guess then that's a great analogy, right? They could just pause, right? They could just say, hey, look, you know what? Things are getting rocky enough that we're just not going to do anything for a while and just stand at the ready. And then if we can resume, great. If we have to rescue, Great. Is that what you think they're more likely to do here, or do you think they're going to try and rush and get this thing cooked as fast as they can before the system, the lights go off in the kitchen?
I think that it really depends on like day to day. Like I think the decision could change for the market's pricing of the Fed decision could change from today to next Tuesday and Wednesday, depending on the market action, right? If there's significant stress at other institutions, you can bet that the market's going to start to price in a pause, and the Fed will probably likely pause. If they feel like this is contained, I think they are going to try to sneak in a few more rate hikes. I think there's going to be more. I think the doves have basically won a lot of ammunition for why they should pause, and the whole idea of cumulative lags, which Lael Brainerd first introduced, but now she's not at the board anymore. So it's kind of interesting because there was this hawkish shift with her departure. Mm-hmm. But now it turns out that her camp has the upper hand, whoever is left of her camp. And we don't quite know who the doves are left in the committee, but this is certainly going to embolden some people to want to stop. So I think a debate that was, the Fed was already getting into a point of division, because the closer you get to the terminal rate, the more kind of nuanced debate there's going to be about how far to go, which is natural. Right. Now there's even more debate, I think, because there's going to be the sort of the diehard inflation fighters who say, no, this is our mission, and we just use macroprudential tools for that. And there's going to be other folks who say, this is, to your point about the dueling tools, this is crazy. This cake looks a mess because it's not working out. Let's rethink. So, but to your other question about what they actually announced, it was all very fast, and reporters had more questions than they had answers. But the basic idea is that they announced. I think the main thing is that they made two things. They made the uninsured depositors for the two institutions whole, but then there's this whole question of like, is this an implicit guarantee to other uninsured depositors and other similarly placed banks, or is it confined to those particular banks? We don't know that yet. And that's, I think, one of the reasons why volatility in the market's going to remain high, is that question remains untested and unanswered and kind of ripe for shorts to kind of test. And so, and the other major thing that they announced is this new lending facility, I guess the bank term funding facility or something like that. I have to look up the acronym again, but there's a lot of them. And that is basically aimed at relieving the kind of funding stress, that the very specific kind of funding stress that SVB ran into, which is this sort of exposure to normally super safe assets like treasuries, which just happen to be deeply underwater because of the Fed's rate hikes. And they can now be used as collateral, and they can borrow, they can be lent at par at this facility for a year, allowing these firms to basically, at the very least, kick the can down the road on these positions, or potentially to exit them in a safer manner. So those are the two major pieces of the announcement.